Hi there, it's Julie Broad with Revenue.com, and I want to share a tool with you, a tool that will help you evaluate and manage risk when it comes to doing real estate deals. First of all, let me talk about some of the risks that are involved in real estate deals, especially when you're buy and hold real estate investors like my husband Dave and I are. Some of the main risks, cash flow. You want to make sure that anything that can impact your cash flow is, any risks of things that can impact your cash flow has been addressed. That anything that's going to impact your money going out or your money going in. But there's other risks and different sizes of risk that you need to be aware of, and that's where this tool really comes in handy, especially if you're a new real estate investor and some things may seem scarier than they need to be, and some things that seem like a small thing could be a really, really big deal. So I'm going to explain this tool to you, and then I'll kind of do an example for you on a deal that we recently did in Kelowna, British Columbia. So let me just first tell you about the three types of risk that you'll find. So I've just wrote them on the board here, and I've got a little write-up that will go along with this in case you can't see the board or you want to have something to print out and reference. Anyway, you have three types of risk. First of all, you have the cost. So those things are things that people usually see pretty easily, and that's what I mean. Money going out, money coming in, what's going to impact it. That's your cost risk. You also have the element of what's the percent chance, what's the probability that that risk is likely to happen. So you're going to look at it and you're going to go, what's the chance that my tenants are going to have to file for bankruptcy and move out? What's the chance that the city might clamp down on an illegal suite? Something like that. And then the third element of the risk that you need to consider is control. What is your manageability of that element of risk? So for example, you don't have much control over a tenant filing for bankruptcy, but you can screen tenants and do things that can mitigate that risk a little bit. As far as the city clamping down on illegal suites, well, the main control you have over that is to, if you buy a property that has an illegal suite, do everything you need to do to get that suite approved by the city. So you don't have a ton of control over that, you have a little bit, but what this tool does is help you identify things like that you can try and reduce the probability of it happening, or reduce the risk financially to you, or increase your control over that particular risk element. Part of step one. Before I get into that, I want to tell you that I haven't made this tool up. I'm borrowing it from Keith Cunningham, who is author of Keys to the Vault and has a business mentoring program by the same name. And I took his program earlier this year, and this is one of the nuggets of gold that I got from the program and that I wanted to share with you. So step one is to list all of the potential risks. So you'll probably find most of the time, everything from outrageous, an earthquake, all the way to, very real risks like a tenant moving out. So list every risk you can see, and then go back through and choose the 10 that are, most realistic, most likely to happen that you want to concern yourself with. Now, I've just grabbed 5, maybe not even the biggest risks to us when we were looking at this deal, but I just want to use them as an illustration for how this tool works. So first, let me tell you a little bit about the deal. It was a single-family home, and we were going to do a rent-to-own on it. And we've never done a rent-to-own or a lease option in this particular market. So one of the big risks we saw was, what's the demand for a rent-to-own going to be? Because not every market has strong demand for rent-to-own properties. We've had experiences with higher-priced properties where it's tough to find a good candidate, a good tenant buyer. Financing challenges. So we had been struggling with financing, and we were, about to lift conditions, and in this scenario, financing was an issue. We didn't want to lift conditions and then not have money to close on this deal with. Cash flow risk. If your tenant buyer moves out and you can't find another tenant buyer, this property, the numbers really only work as a rent-to-own because the tenant buyer covers many of the expenses as well as pays a slightly higher rent. So if they moved out and we couldn't find one, there's cash flow risk there for us. The area risk, it's a pocket in a city, a very small pocket, surrounded by industrial, and it's improving. But if something happens and changes that and it doesn't continue to improve, there's risks with this area. And of course, city laws. One of the big appeals of this property for us was that it's RU6 zoned, which basically means you can add a legal suite or a carriage house onto it. So that was an alternative exit strategy, or a way that we could add more cash flow to it in the future. But laws change, as you know. So those were our main risks. So once you've listed your risks and identified the highest probability risks, your next step is to go through and assign them each a probability of happening. And once you've done that, what you're going to do is draw a circle beside them relative to the size of the probability. So for example, let's just say city laws are unlikely to change. So I'm going to draw a small circle. Hopefully you can see that. Now, cash flow risk, well, that's a real possibility that our tenant buyer moves out. We feel we're pretty good marketers, so we can probably fill it. However, it's still a risk. Financing challenges, definitely a risk, but yeah. And at the time, when I'm looking back, the probability of us not getting the financing we wanted was pretty substantial. So I'll give it a big circle. And demand for rent to own at the time, we really didn't know. So I'll give it a big circle. So basically, as you can see, you're taking your best guess of the probability of something happening with that risk, and you're assigning something visual to it. And now I'm just going to show you what you do with that. Okay, so what I've done is I've now plotted those risks, well, some of them, on this chart. And what you do is you draw a line down here and a line here. And what this represents is the cost. So something that's up here has a high cost if it happens. Something that's down here is something that you don't have very much control over. So what you really want to avoid is big circles up here, because that means the cost of it happening is big, the probability of it is likely because it's a big circle, and you don't have control over it. So that's what you're trying to avoid. Now, when you first do this, you're doing this so you can visually see where your risks are, and then what you want to do is move them. So when we look at this with financing, what we did to move the risk down and make the circle smaller, which is what you're trying to do. You want to reduce the cost, increase your control, and minimize the probability of it happening. So we secured private financing. We were trying to get some juicy rates on the conventional financing, but we secured private financing so we could continue to try and get conventional financing, but have a backup plan in place, which moved our circle, made our circle a lot smaller, and minimized our cost. We wouldn't lose our deposit that we had put down, and it increased our control over the deal. So other circle that we wanted to address was rent to own demand. We weren't familiar with it, so we didn't know if there was going to be demand. So before we actually bought this property, we were advertising it. Before we had possession, we had already secured a rent to own buyer for it, a tenant buyer for it. So we shrunk that, and we basically removed that circle. We, within a day of advertising it, we already had 30-some inquiries, so we felt pretty confident that there was, in fact, demand for it. But those are some of the things you do to decrease the size of the circle and move it down so it costs you less if it does happen, and you have more control over whether it happens at all. So hopefully you find some use out of this tool. Some people really like to see things. And no matter what, I hope you are looking at risks, writing them down, and considering what could happen in your real estate deals and finding ways to reduce the risk. Oh, and if you want to download this, it should be, if you're on the blog, there'll be a link where you can download a little one-page sheet for this. And if you're watching this on YouTube, there should be a link right beside the video that should direct you to where you can download the sheet. Thank you.